Hey, what's up, my friend? So, I have been trading for more than a decade now, man. Man, time flies. And I've learned a few things along the way. For example, like how to lose money with one click. How to piss off your wife at 4 a.m. in the morning. And sometimes even how to do both at the same time. Try to beat that, yeah? So I've been there, trading for 15 years, and I've made the mistakes, listened to the wrong advice, and paid the price. But hey, I'm still here shooting this video. That explains the importance of risk management. Hint, hint. So in today's video, you will learn what I wish someone had told me when I was first starting out. There is no fluff, there is no hype, there is no Lambos, okay? Just the real truths that I've learned over the last 15 years. Sounds good? Then let's get started. First, you must have an edge in the markets, or rather, your trading system, your trading strategy must have an edge. You might be wondering, man, Rayner, what is an edge? An edge is something that you do repeatedly that yields a profit over time, otherwise also known as a positive expectancy. And by the way, if your edge is using 19 indicators on your chart, you don't have a strategy, you've got a Christmas tree, okay? So how do you then define an edge? So you can define an edge using this mathematical formula. Don't freak out, right? Because it's simple that even a 12-year-old can figure this one. So E, right, stands for either expectancy or your edge, is equals to your winning percentage multiplied by your average gain, minus your losing percentage multiplied by your average loss. I'll walk you through an example so you can see how this works. So let's say you have a trading system that has a 70% winning rate. Your average gain is $80 and your losing rate is 30%. Why 30%? Because 100% minus 70%, you'll get 30%. So that's your losing rate. And let's say your average loss is $100 per trade. So what you're going to do is to plug in these numbers into the formula I just shared with you earlier. So this is your winning rate multiplied by your average gain, your losing rate multiplied by your average loss, and you'll get $26 per trade. So this means, right, what does this $26 means? This means that you can expect to earn an average of $26 per trade. So let's say you have taken 100 trades using this trading system. What you're going to find is that you will have about $2,600, right, after taking 100 trades. So this is what it means to have a positive expectancy, and this is what it means to have an edge in the markets. Your E, right, your expectancy has to be positive. If it's negative, then clearly you don't have an edge, and the more you trade, the more you will lose. Now, a question for you. Which is more important, your winning rate or the risk to reward ratio? I'll give you 5 seconds. 1, 2, 3, 4, 5. Okay, the answer is this. The most important metric is, it's a trick question. Actually, both of them are equally important, because on its own, let's say on its own, your winning rate is meaningless, because you can have a 90% winning rate, a 95% winning rate. But let's say every time you win $1. But every time you lose $100. So despite having a very high winning rate, you still have a unprofitable trading system. And likewise, it's true. You can have an amazing risk to reward ratio. Let's say every time you risk $1, you make $3 back, right? Quite a favorable risk to reward ratio on your trades. But what if your winning rate is only 10%? Then what use is that? You still have a unprofitable trading system. So to know whether your trading system has an edge in the markets, to know whether you have a positive expectancy, both your winning rate and risk to reward ratio, you must combine them, because both of them matters. Okay? Now you know that having an edge is important, okay? But to be a consistently profitable trader, you still need this. Next up, you must master risk management. This is, if you ask me, the lowest hanging fruit that you can tackle in trading that will pay you dividends for the rest of your trading career. Because it doesn't matter if it's your first day trading or your 20th year trading, because risk management is something that you need on your first day of trading as well as your last day of trading. So what does risk management means in trading? Risk management means, right, that you're able to protect your downside no matter what happens in your trading. Whether you have 5 losing trades, 10 losing trades, 20 losing trades in a row, guess what? If you have sound risk management, you should be able to survive and to live to fight another day. Because without sound risk management, even the best trading system, even a profitable trading system will fail. Let me give you an example. This is so important that I must hammer home this concept. So imagine this. Imagine there are 2 traders, John and Sally. They both have a $10,000 trading account. So they have the same size trading account. And let's say they trade the same trading system, and the trading system has a 50% winning rate. Let's say on average they make an average of a 1 to 3 risk reward ratio. So let's say, for example, if you risk $100 and you earn a 1 to 3 risk reward ratio, it means that you would have gotten $300, right, for a winning trade on average. And John, he's the kind of trader that goes big or goes home, so he risks $5,000 per trade, which is about 50% of his account. And Sally is a lot more conservative. She risks 1% of her account, right? $100 of 10K is 1%. And also, let's assume the outcome of the next 10 trades are this, right? The first trade is a loser, second is loser, 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 and then win, 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 win. So basically, you encounter 5 losing trades in a row before you experience the winners. Now, how would the result fare for both traders? So let's look at John. So John, you know that he risked $5,000 per trade. So first trade is a loser, second trade is a loser. So minus 5K and minus 5K. You can see that John is pretty much wiped out. He's blown up, right? He has blown up his account because he was too aggressive in placing his trades. Taking too much risk on each trade. What about Sally? Okay, so you can see Sally, she risked $100 per trade. So first 5 trades are loser. 1, 2, 3, 4, 5. And you know that she risked $100 per trade. So her total loss, right, will amount to something like $500. Okay, but because she has proper risk management, she lived to fight another day. So you can see that she get to experience the profits that will come her way. And she experienced this next 5 winning trades. 1, 2, 3, 4, 5. And as you know, this system has an average of a 1 to 3 risk reward ratio. This means on average she wins $300 per trade. And she had 5 winning trades over here. So in total, it's about $1,500 over here. So $1,500, you minus the initial loss she experienced, you can see that in total, Sally would have made a profit of $1,000, a 10% gain on her account. Whereas John, he blew up, right, because he took on too much risk. So by now, I want you to see that risk management is key, because you can have a profitable trading system, you can have the best trading system in the world, but if you don't have proper risk management, you will still lose, because you're not giving your trading system a chance for it to play out its age in the long run. Now, if you are like John, right, you risk 30, 40, 50% of your account on one trade, then my advice to you is to go to Vegas. At least they give you free drinks, right, while you lose everything. Okay, moving on. Trading psychology is not the answer. So let me explain why. So often, right, you've been told that, trading is 80% psychology, man. You need to master your emotions. You need to follow your rules. You need to be more disciplined. So imagine this. Imagine you go down to a casino and you bring along the best psychologist, the best hypnotist that you can find to help you be a disciplined gambler, someone who follow the rules of your betting system. Let me ask you, will you profit against the casino in the long run? And I'm sure that you would agree the answer is no, of course not. Why is that? And the reason is because you don't have an edge over the casino. You don't have an edge over the house. In other words, you can master your trading psychology that you look and feel like a monk, but if you don't have an edge, it doesn't matter because you will still lose consistently. Agree? So now the question is this. What is successful trading about if it's not about psychology? It's this. Okay, I've broken it down into this formula. This is what I call the trading success formula. So trading success is when you have an edge, sound risk management, and the discipline to follow your rules. And by the way, you must have all three ingredients. You can't, let's say, you have an edge, but you don't have sound risk management. Then what's going to happen is that you'll eventually blow up your account. Like John earlier, he has an edge, but because he didn't have sound risk management, he blew up. That's what happens when you have an edge without sound risk management. What if you have, let's say, risk management and discipline, but no edge? Then what you're going to do, what's going to happen is that you will suffer death by 1,000 cuts. You have risk management in place, but because without an edge, you slowly bleed your account over time till there's nothing left. And what if you have an edge and risk management, but no discipline? Well, in this case, you get inconsistent results. So as you can see, right, in order to be a profitable trader, a successful, consistently profitable trader, all three factors or ingredients are required. So my point of view is that trading is 20% psychology, because when you have an edge and sound risk management, your discipline will naturally take care of itself, right? From the hundreds of students that I've trained, usually when they have an edge in sound risk management, I don't really hear them or complaining to me, hey Rayner, I'm struggling with discipline. All the discipline issues naturally melt away. And for example, imagine this to prove my point, right? Imagine that you have a coin. Every time you toss the coin, it comes up heads, you win $100. Every time it comes up tails, you lose $50. Let me ask you, will you struggle to toss the coin? Will you feel like after 3 tails in a row, you struggle? Man, Rayner, I can't seem to toss the coin the 4th time. So what if I lose? I think 99% of the population won't face that problem. And if you happen to face that problem, it means that the loss that you're taking is too much. You probably want to dial back down your risk instead of maybe losing $50 on each coin toss. You want to maybe reduce down your bet size to maybe $10 or $20 to a level that you're comfortable with. Because as you can see, once you have an edge, once you have a sound risk management, most traders will not face issues with trading psychology. And for those people who tell you that trading is 80% psychology, man, probably those are the ones that have a trading psychology course to sell you. Next up, you don't need to predict what the markets will do in order to be a profitable trader. I know that sounds kind of, weird, right? But Rayner, don't I need to, predict what the markets will do in order to make a profit? No, not quite. And in fact, I like to share with you an example. As you can see, I'm a fan of, sharing examples to break down concepts so you understand the logic behind it. So here's another example. So imagine this. Imagine you have a trading system that wins 60% of the time. And follow along with me. Let's say you have an account size of $10,000. Your average gain is $100 and your average loss is $100. So in other words, this trading system has a 1-to-1 risk to reward ratio. And on average, you earn 1% on your trades. And on average, your loss is also about 1% on your trades. But you have an edge because of your winning rate, 60%. And if you recall, I shared with you earlier the expectancy formula. It's over here. And if you plug in the numbers into the formula, you know that E is $20. This means that you can expect to make an average of $20 per trade. Now, let's go back to the part earlier where I said that you don't need to predict to profit. So, as you know, to simplify things, if you have a 60% winning rate on average, if you take 100 trades, about 60 of them is going to be a winner, and 40% of them will be losers. So I've simplified this further. I'm not going to give 100 trading examples. This is just a potential outcome of 10 trades. So this is scenario number 1. Let's say for this scenario, first trade is a winner, 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 winner. The first 6 trades are winning trades, followed by 4 losing trades over here. Now, if you know that your expectancy on average each trade you will make $20, you know that after these 10 trades, you'll be up $200. And in fact, if you don't believe me, You can just plug in the numbers. Let's say average gain over here is $100. You know that you have 6 winners in a row, total is $600. Minus the 4 losers, which gives you a net loss, a total loss of $400. End up, you'll be $200 ahead. So again, first scenario, you'll be up about $200. Let's look at the second scenario. This time around, you encountered 4 losses in a row. 1, 2, 3, 4. Followed by 6 winning trades. Again, if you do the math, you will be up around $200, right? So this $200 is not guaranteed. It's just there about average, right? In the real world of trading, the number will be slightly higher, lower, and whatnot. Okay, so if you do the math, you will be up about $200 for this scenario number 2. And finally, the third scenario, same thing. If you have, let's say, 3 winners in a row, you're going to get $300. Then followed by 4 losing trades, you minus $400. And then finally, you have another 3 winners in a row, plus $300. End up, you're going to be making about $200 in profit as well. And I'm showing you these 3 examples is to let you know that you don't need to predict in order to profit. Because can you predict that, hey, these next 4 trades are going to be loser? You can't. You have no idea what's going to happen next. Likewise, can you predict that the next 6 trades, they are going to be winning trades? You can't. And then let's say after the next 6 winning trades, you get 4 losing trades. Are you able to predict that? You can't. You can't predict the outcome on any individual one trade. But, and this is important, pay attention. But if you have a proven trading system that works, if you have a positive expectancy, all you need to do is to let your trading system do the work. All you need to do is to let your edge play out. All you need to do is to follow the rules of your trading system, and given long enough timeline, given a sufficiently large sample size of trades, you will come out ahead. Does it make sense? You don't have to predict what the market will do over the next trade, the next few trades, because if you have an edge, if you have sound risk management, if you have the discipline to follow the rules, eventually you will come out ahead. I'm pretty sure that at one stage or another, you were trying to find the best trading strategy. I'm here to tell you right now, don't bother. Don't bother trying to find the best trading strategy. And why? The reason is simple. Every trading strategy is designed to profit from a specific pattern in the market. Let me explain. Say, for example, a trend following strategy. Trend following usually does well when the markets are trending. When it's in an uptrend, you ride the uptrend higher. If it's in a downtrend, you can ride the downtrend lower. And of course, if the market is range bound, choppy, false breakout, a trend follower will not do so well in such a market environment. On the other hand, you have a mean reversion trading strategy. A mean reversion trading strategy looks to buy when the market is temporarily oversold. Something like, let's say, market, or rather the stock goes up, comes down, goes up, comes down, and then it's currently oversold, massive sell-off. What a mean reversion trader will do, he'll buy in anticipation that the stock price will bounce up higher, and then you sell for a profit. So this is what mean reversion trading is about. Buying low, selling high, or selling high and then buying back at a lower price. So these are 2 different trading strategies, and none of them works all the time. They just simply work when the market conditions are favorable to them. And if that's the case, if you agree with what I just said, then I'm sure you can agree that market conditions, they change all the time. Right? As you can see, right, the S&P 500 this year, last few years, could be in an uptrend, and you never know whether it's going to go back into a bear market, like what we've seen in the 08-09 financial crisis, or it goes into a range, a choppy market, etc. The market changes all the time. You just look at any charts on the daily, the weekly time frame, you can see that the market conditions is always changing. And if you agree with that statement, then you would know that no trading strategy will work all the time, because market conditions change all the time. So this is why I say, don't bother finding the best trading strategy. Don't bother finding something that works all the time, because it doesn't exist. The good news is, I found something pretty close. Now, let me explain to you how this works. So earlier I've shared with you two types of trading strategies, right? Trend following and mean reversion. Trend following does well when the market is trending. Mean reversion usually would do well when market is kind of like choppy in a range. Mean reversion trading will do well. So if you look at the results of this trading system, right? This is a trend following system. You can see that since 2000, it has generated about 2,900%. And if you break this trading system down, the results to a year-on-year and month-on-month results, you can see that over the last 24 years, we have a few losing years, notably in, I think this is 2009, this one is probably 2012 here, and 2023. And what's interesting about trend following is that it usually does very well during a crisis period. For example, this is the dot-com bubble, up about 23%. 2008 financial crisis, up about 80%. COVID, up, this case, 23%. Russia-Ukraine war, 42%. So you can see that when there is crisis, when there is panic in the markets, trend follower usually would do well during this period. Next up, we have the mean reversion trading system, up about 8,000% since 2000. And again, if you break this down on a year-on-year, month-on-month basis, you can see that again, the mean reversion trading system, it doesn't make money every year. We have a couple of losing years over here, and this is 2014, and over here, 2022 over here. 2022, no surprise, because this is a stock mean reversion trading system, and 2022, I believe the S&P 500 was down for the year. It was a bear market. So with this in mind, if you look at this, right, these are the two trading systems I've shared with you earlier, the trend following and the mean reversion one. And what you're seeing over here is the yearly returns over the last 24 years. You can see that the trend following system had 1, 2, 3, and 4 losing years, and the mean reversion trading system had 2 losing years. So now the question is this: how can you reduce the chance of experiencing a losing year? How can you reduce, or rather increase, the chance of making money almost every year, regardless whether it's a bull market, a bear market, or during a recession? So the secret is this. The secret is, let's say for example, you have $10,000 trading capital. You don't want to put all 10,000 into, let's say, the trend following system or the mean reversion trading system. Instead, you want to split it, let's say 50% into trend following and 50% into mean reversion trading. And when you do that, this is where the magic happens. Boom, right? Look at this. If you look at it, at this column over here, the column says net, you can see that you are profitable almost every single year, whether it's a bull market, a bear market, or even during a recession. The one year that you lost money is in 2023, down about 5% for the year. But the point I'm trying to make is that no trading strategy works all the time because market conditions change all the time. But when you have multiple trading strategies at your disposal, you have a good chance of making a profit almost every single year. And by the way, if you want to learn more about trend following systems or mean reversion trading system, I have this book over here called Trading Systems That Work. You can grab a copy at this link over here. Just go down to tradingsystemsbook.com and you can grab a copy of this book, and it's like what, $17, and you get 3 proven trading systems that work, the exact entries, exits, trading rules all given to you. And you're backed by a 180 days money back guarantee. If you're not happy or whatsoever, you can just email us and we'll happily refund you in full. So there's zero risk for you in grabbing a copy of this book called Trading Systems That Work. Here's a quick story of my own trading journey. So I started out in the forex markets where I was on baby pips, and I came across this thread, someone teaching a Bollinger Band trading strategy, right? Wait for the price to come to the lows of the Bollinger Band, you buy. And when the price reaches higher, touches the high of the Bollinger Band, you sell. Profit. So that's what I did. So made some money at the start, only to lose it all later on. So then I figured to myself, maybe the strategy isn't working. So that's where I started looking around and came into the trading world of indicators. I realized that, wow, there's so many different tools I can use, not just Bollinger Bands. I have RSI, MACD, Fibonacci. So I tried all these different tools, and guess what? Made some money, but all in all, I lost more money than I made. Then that's where I hop onto the world of patterns, harmonic patterns, volume, and this exact process rinse, repeat itself. So the big breakthrough that I got was when I read this book called Market Wizards by Jack Schwager. So in this book, Jack, he mentioned that every successful trader that he has interviewed, they all have an edge in the markets. So that was my first breakthrough. Oh, I need an edge in the markets. The second breakthrough came right when I realized that in order to know whether you have an edge in the markets, you need to take a strategy, a concept, and to turn it into a fixed set of rules. From this fixed set of rules, then you need to test how these rules has performed, whether through forward testing or back testing. For me, my preference, I like to back test. So this is why you need to test your trading system. So for me, I like to go with the approach of back testing, which is simply back testing a strategy across the past data to see if it works or not. So I trade a lot of the stock markets. So I like to backtest over the last 10, 15, 20 years across different market cycles, in a bull market, a bear market, and see how it has fared over time. And what you're trying to do is to answer this very simple question. If I had traded this system before, if I had taken this set of rules that I've created before and traded in the past, would I have made money? And the reason that you want to do this is because it allows you to validate your strategy, to help you identify the strengths and weaknesses of the strategy, and to build confidence. Let me prove it to you. So have a look at this equity curve over here. Imagine this. Imagine I told you. Imagine your name is Rayner. Hey Rayner, I've just developed this trading system, and this is the equity curve of the backtest results over the last 24, 25 years. Since 2000, it has made about 8,000% return, about an average of an 18-19% annual return. Now let me ask you, is this something that you would at least give it a shot to trade it in the live markets? Assuming you know the logic and the rules behind this system and you think it's sound, will you at least give this system a chance to put a little bit of real money on the line? I think for most traders who look at this equity curve, I think it's probably a yes. At the same time, what if you come across an equity curve that looks something like this? And I tell you, hey Rayner, this is the results of my trading system over the last 25 years. It has lost 99% of your money over the last 25 years. Would you want to trade it? Heck no, right? I think nobody wants to trade a trading system with such horrendous results. So this is why, if you have the ability to test your trading system ahead of time, you would have saved yourself a ton of time and money. And so this is why it's so important to test, and test. And of course, if you want to do the back testing on your own, that's where you can use leverage the works of other traders like me, right? Where I wrote a book called Trading Systems That Work, contains 3 proven trading systems with the complete trading rules, the backtest results, all in the book as well. So I'll put the link somewhere below this video. You can check it out if you want. So many traders think that in order to make the big money in trading, they must take huge risk, to take big bets. That is like someone who sees a wall and the wall could possibly just be filled with wet paint and they want to verify it. So what does the person do? He takes his entire palm, the full palm, and pia on the wall, instead of using one small finger just to test whether if it's wet or not. And of course, with the full palm, right, your entire palm is now filled with paint. You want to get rid of it, you smear it on your shirt, and now you look like a complete mess. And that's what you're going to be, a mess, if you take big risk in trading. You likely blow up your trading account. So what you want to do is this. Let me walk you through the safe and consistent way to grow your account to 6 or 7 figures and beyond. So imagine this, right? Imagine, let's say, I'm going to assume you guys watching this, maybe in Singapore like me, you have $20,000 somewhere to fund your trading account. So let's say you start with a $20,000 trading account. Let's say you are 35 years old this year and you can possibly grow your account for the next 20 years. Even if you're 45 or 55, you can as well, but whatever. You grow your account for the next 20 years. And let's say your trading system strategy makes an annual return of about 17% a year on average. So after 20 years, how much will your account be worth? You might be thinking, Rayner, I'm not an idiot. The answer is listed over here. You're right. Okay, the answer is that your account will be worth $462,000 after 20 years, assuming you compound it for the next 20 years at an average return of 17% a year. Let's be honest, this isn't life-changing money. So what else can you do about it? So what else you can do is this. Let's assume that you're going to keep your starting capital the same, you compound for the next 20 years again, you're not extending it, and you're using the same system with the same risk management, so the same 17% a year. And the only difference that you're doing is this time around, you add an extra $20,000 to your account each year. How much difference would that make? So I'll give you 5 seconds to think this through. 1, 2, 3, 4, 5. Okay. So previously you saw that your account would have been worth, I think, about $462,000. Now, by making this one simple tweak, regularly adding funds to your account now will be worth, get ready for it, it will be worth $3.5 million. I kid you not, you can even do this compound interest calculation on your own. So can you see how powerful this concept is? You didn't change your trading system, you didn't take on more risk, you didn't change strategy or whatsoever. The only thing you did is to regularly add funds to your account each year. Now you might be thinking, but Rayner, if it's so easy, then why don't many traders do it? Well, because it's slow and boring. And here's my question to you. Would you rather take it slow and boring and to make the big money, or go fast and exciting and lose everything? Now, you might be wondering, but Rayner, profitable traders, they are smart. They have an above average IQ. They are math wizards. Well, I'm here to tell you that that is not true. Take me for example, I have a very average IQ. If you ask me, I think my IQ is just 100, slightly above thereabout. I've got a GPA of about 2, and I failed math in school. You can see over here, this is my report card back in school. Failed almost every subject out there except English. So here's the thing, right? If wits and IQ, they are not essential, as long as you're average, I think that's good enough, then what is essential? What is required? It's this. You must commit. You must commit to, number one, finding an edge in the markets, to find a trading system that you know will yield a positive result in the long run. And if you struggle with that, don't worry, because you can go down to my website over here, tradingwithrayner.com. Okay, and this guide over here, right, at this website, you scroll down a little bit and look for this guide called the Essential Guide to Systems Trading. In this guide, I will share with you my approach to finding proven edges in the market without trial and error and without wasting time going around in circles. So download this guide. I'll share with you the red formula. This is the formula that I use to get new trading ideas that give me an edge in the market, so I can develop trading systems that work. Okay, so I'll put a link somewhere below this video so you can grab a copy of this guide. Next one, you must commit to managing your risk, and it's not difficult. Risk management, I think I've talked about it earlier. It's the lowest hanging fruit in trading, because it's going to be relevant on day one as well as on your last day of trading. And give yourself 45 minutes to an hour, and that's it. You will understand the math behind risk management, and it will pay dividends for the rest of your life. So commit to this. Next, you must commit to following your rules. And based on what I've seen, the smarter someone is, the more they tend to struggle, because they think that they are smarter than everyone else. They are better than everyone else. They can dictate the rules. They know when to break the rules. And that's where trouble seeps in. So if you're average, congratulations, right? If you're average, then this should be easy for you, because you know that you're not the smartest out there. You have a proven system that works. You don't want to reinvent the wheel. You just follow the rules, and that's how you get results. So congrats on being average. Yay, right? Finally, being average is it's a blessing, because once you have an edge in risk management, being average will help you better follow the rules. And let's say you are the unfortunate few, you are blessed with talent, with smartness, IQ, and you struggle with following the rules, then here's a tip for you. What you can do is to find an accountability partner, right? Every time you break your rules, guess what? You bring your partner to shopping, right, with a budget of $500. And I'm pretty sure, right, very soon you'll have no issues with discipline. Try that, right? Let me know how it works out for you. Okay? And next one, you need to commit to learning. So you don't need a high IQ to learn. You just need a thirst for knowledge. And remember, you are always a student of the markets, regardless of where you are in your trading journey. Not yet profitable, break even, very profitable for the last 10 years. You are still a student of the markets. The learning never ends. And finally, commit. Commit to figuring shit out. There's a lot of things to figure out in life, as well as in trading. In trading, nobody's going to spoon feed you, what exactly to do step by step, because nobody is as invested as you. So here's the thing, you don't need a high IQ to figure things out. You've got ChatGPT, Google, YouTube, library, books. If you ask the right questions, I 100% believe you will get the right answers, but only if you commit to figuring things out on your own. But you must put in the effort. Yeah, don't expect things to be handed on a silver platter, because it's your money that's on the line, and nobody cares about your money more than you. So trading isn't a genius IQ test. Let's face it, right? It's a marathon. You don't win by being the fastest brain in the room. You win by not giving up. So, look at this. On average, you take 11 years to be a doctor. And depending on the type of doctor you want to be, if you want to be a neurosurgeon, you probably would take even longer. 7 years to be a lawyer. 5 years to be an engineer. And guess what? You get into trading, and within a year, you expect to be profitable, to generate another source of income, to quit your full-time job, sip a cup of pina coladas by the beach and call it quits, right? Life is good. Doesn't quite work that way, because if that's the case, then there will be no more doctors, lawyer, engineer in the world. Everybody's going to be traders getting drunk by the beach. Yeah, so that's a reality check. So if you ask me, as a trader, you will likely go through 5 stages in your trading journey. And I want to walk you through what these 5 stages are. So number 1, I can better manage your expectations. And number 2, you know what to expect in each and every stage of your journey, and how to kind of shortcut your learning curve and jump to the next stage, right, as efficiently as possible. Let's go. Stage number 1 is what I call the hyper newbie stage. So at this stage, you feel very excited. You have high hopes about trading, of the possibilities out there, financial freedom, quitting your job, you don't have to answer to bosses. Oh man, life, it's beautiful. Okay, so you are very eager to learn everything and anything about trading. And at this stage, you start to realize, man, you lose one trading account, you lose another trading account, and then you stumble upon and realize you've been blowing up multiple trading accounts, and trading isn't as easy as it seems. So at this stage, you kind of realize, man, I need proper risk management. And once you realize that, you move on to stage 2, which is what I call the risk manager. So at this stage, once you master risk management, you've stopped blowing up your trading account. But the problem you face at this stage is that you realize you're still not making a profit. In fact, you're still losing consistently over time. Yes, you don't have big, massive losses, but these little small losses starts to add up, right? And you're suffering death by 1,000 cuts. And at this point, you would then realize you need something, which is what I called earlier, or shared earlier, an edge. You need an edge in the markets. So once you realize you need an edge in the markets, you would move on to stage 3. This stage, I call it the Lone Ranger stage, because at this stage, you have probably 1, 2, 3 years trading experience under your belt, and you've learned so much stuff about trading. You know price action, chart patterns, trading strategies, systems, volume, profile, etc. But still, you're not seeing the results that you want. But still, you're not able to turn your knowledge into profits. That's the problem that you have. So at this point, right, this is where you realize that you need a trading system that works. You need to develop a trading system that gives you an edge in the markets, and either through back testing or forward testing. Okay, so this stage personally is the stage that I was stuck in the longest. But once you graduate from this stage, you move on to stage number 4, profitable trading stage. Give yourself a pat on the back, because at this stage, only a small percentage of traders will make it. So if you're here, be proud of yourself. I am very proud of you, because, good job. So at this stage, you have been profitable over the last 12 months. So your equity curve in your trading account, it's kind of going up higher over the last 12 months. And the problem you face at this stage is you realize that your strategy has its limitations. It's not going to go up a nice smooth equity curve over 12 months. It's going to go up, jagged, goes down, then breaks out higher, then makes a pullback range, and then breaks out higher once again. So this is where you realize that your strategy has its limitations, because it only works well in certain market conditions. So this is where you realize you need to adopt multiple trading strategies so you can profit in different market conditions, which is the holy grail that I shared with you earlier. And when you realize that, this is where you move on to stage 5, the business owner stage. At this stage, you are a profitable trader and you want to take your trading to the next level. So what you're doing at this stage is you research new trading systems, new strategies. You're raising capital to grow the size of your account, maybe through managing funds. I hope not taking on debt, all right, from the banks and whatnot, yeah? And you're using technology to make your trading life easier, maybe through the use of automation. So at this stage, you're kind of like a business owner, right? Running multiple trading strategies, developing new strategies, automating it, and you are treating business, or rather trading, as a business. So a quick recap, this is the life cycle of a trader, right? Number 1, you start off with the hyper newbie stage, then you move on to the risk manager stage, the lone ranger, the profitable trader, and then finally business owner. Now some of you are thinking, Rayner, when can I get to the profitable trading stage? I mean, it really depends on how open you are to learning and receiving feedback, but generally most traders that I see, if they have the right tools, resources, and mindset, they could get there, 2 years, 2.5 years. That's, I would say, the fast side. The slow one, I think maybe, I wouldn't say slow, but the average people will probably take 3 or 4 years or more, because there's a lot of lessons, there's a lot of things that you have to experience yourself. You have to feel it. You have to fail at it. Only then can you move on forward. Because if you don't fail, then you won't have the feedback. You won't realize the thing that's holding you back. Yeah, so that is the life cycle of a trader. So let me share with you my thoughts. So recently I have thoughts of getting a landed property in Singapore, because the property market in Singapore is very strong and landed properties have strong capital appreciation. And on top of it, right, because you're buying a property, you can take a loan from a bank and leverage your returns. So in landed in Singapore, it's reasonable to make an extra 10-15% capital appreciation, right, on top of the capital that's invested for landed property in Singapore. So I shared this with my wife, and she said this. For what? Then I said, to make more money. And then she's replied, for what? And then crickets. That's because, right, me and my wife, we both have come to an agreement that money is a means to an end. And she gave me a reminder that money is a tool. It's a means to an end. You don't want to end up chasing more and more just because everyone else is doing it. Because what's going to happen is that you will miss the forest for the trees. So thank you, darling, right, for that timely reminder. So trading is a means to an end, but the question is for you is, what does the end look like for you? So let me share with you my version of it, and you can go back and think through about yourself. So for me, trading allows me to better provide for my family so they don't have to go hungry, and I can give them a better quality of life. If let's say one day YouTube decides to ban my account because I go, hey, what's up, my friends? Guess what? Trading still gives me a reliable source of income, right, from the markets. Next, trading allows me to be present for my family and children, because for me, trading takes me less than 20 minutes a day, and I am very involved with my children's lives and the things that they are doing day to day. This allows me to help shape their character, impart the right values, the right knowledge, and to help them become good adults to contribute back to society when they are older. Trading also helps me to realize that money, they are just digits, numbers on the screen. And I'm not defined by how big or small those digits are. Okay, remember this. You're not defined by what you have. Doesn't matter whether you are living in a bungalow or in a small house. It doesn't matter. You are defined by who you are. Because if you know who you are deep down, you know what's your purpose, what's your contribution. That's all that matters. And some people just never figure that out because they're always chasing for more and more, being manipulated by the digits, the money that they have in their bank account, which at the end of the day, really, you can't take it to the afterlife. Trading also allows me to make money my slave and not to be a master. Okay, in other words, right? Money is a slave to me and I'm not treating it as my master. So I can use it to spread God's love and to help those in need, because it is a very rewarding, a fulfilling experience when you help some random stranger on the street just because you want to give them hope. It's a very positive, happy feeling. If you've never tried it before, I encourage you to do so you can know what I mean, because it is like donating $10, and that $10 will bring you so much happiness that there's no other way to spend that $10 and to derive that level of happiness. You can buy, 5 plates of chicken rice. Okay, you can't get 5 plates of chicken rice for $10, but it's the best $10 that you can spend to get that high level of happiness. Okay, so this is what trading means to me. So to end it off, right, my question to you is this: what does trading means to you? Leave a comment below this video and let me know your thoughts. Now, let's do a quick recap. Number 1, your trading system must have an edge in the markets, because without an edge, nothing else matters. You can have the best risk management, the best trading psychology, and guess what? You still will not be a profitable trader. That's how important it is to have an edge. Next one, master risk management. This is the lowest hanging fruit that you can tackle right now that will pay dividends for the rest of your trading career. It's not difficult. 45 minutes to an hour is all you need. And risk management will allow you to live to fight another day through the darkest times, through 10 losing trades in a row, through a losing streak. Number 3, trading psychology is not the answer. If right now you are an unprofitable trader, you are a losing trader, a break-even trader, high chance it's nothing to do with your trading psychology. Very high chance is number 1 and number 2. If you focus on finding an edge and your risk management, you'll realize that your trading psychology will naturally fall into place. So really, right, I think for most of you watching this right now, trading psychology is likely not the root cause as to why you're not a profitable trader yet. I have faith in you, so it's yet. Number 4, you don't need to predict to profit. I've shared with you that if you have an edge and sound risk management, you may not know whether the next 1 trade, 2 trade, 3 trades is a winning or losing trades. But what I can assure you is that if you have an edge and risk management, you will be profitable still in the long run. That's the power of having an edge. That's the power of having an edge with sound risk management and the discipline to follow your rules. You don't need to predict whether the next trade will be a winner or loser, but you know, in the long run, you will be a profitable trader. Number 5, don't bother finding the best trading strategy. Why? Because it doesn't exist. Is that, market conditions change all the time. And that's why no trading strategies is going to work all the time. Number 6, the next best thing you can do is to have multiple trading strategies. So this way you can profit in different market conditions. Strategy for a bull market, strategy for a bear market, strategy for a range market. You can cover all the different bases. Number 7, you must test your trading system, so you know whether it works or not. You can even do it via back testing, which is my favorite approach, or forward testing, which is more for discretionary traders. Number 8, compound your returns and regularly add funds, because this is how the big money is made. I always like to say that trading is not a get-rich-quick scheme. It's more of a get-rich-slow scheme. And slow but not very slow, because you give it like 10, 20 years, you would have compound a pretty decent sum of money that will put you way ahead of your peers had they not been in trading or investing. Number 9, your commitment is more important than your wits. You don't need an IQ of 150. You don't need a GPA of 3 or 4. Take me, for example. I have a very average IQ, very mediocre GPA, but still, if you have the commitment, if you persevere, if you outwork everyone else, I believe you can make it as well. Number 10, go slow to go far. I've shared with you the 5 different stages of trading, and hopefully you know what it takes to get from one stage to the next and to better manage expectations along the way. And last but not least, trading. Trading is a means to an end. Everyone wants to do trading because they want to make more money. But remember this, money is just a tool. Don't make money your slave. Make it serve you. And what does having more money means to you? What does this financial freedom means to you? To different people, it means different things, right? Money could be used to help others. Money could be used to improve the quality of life of their family and loved ones. Money could be used to be a blessing to those in need. Whatever it means to you, trading is a means to an end. So don't forget that. Don't get so sucked up in the world of making more and more and more till you miss the forest for the trees, and you realize that at the end of it all, you kind of have led a life which is, very superficial, without really much to show for, or without knowing who you really are inside, because you are so busy chasing the material stuff that you lose your soul along the way. Yeah. So with that said, if you want to learn more about my trading approach, systems trading, then again, you can go and grab a copy of this guide, which I highly recommend. It's called the Essential Guide to Systems Trading. I talked about this one earlier. This is where you will learn how you can actually develop your own trading strategies, your own trading systems, how to get new ideas. Plus, I'll even share with you a simple trend following system that works so you can profit in bull and bear markets even during a recession. So the link is, just go down to my website, tradingwithrayner.com, click on this orange button, and I'll send this guide to your email for free. So with that said, I wish you good luck, good trading, stay safe. I will talk to you soon.